What's going on, everybody? Real Trader Joe here. Welcome back to another episode of the 6-Minute Bit, where I do my damnedest in 6 minutes or less to give you guys option strategies that you can use today. I know you guys probably realized I changed it from 5 minutes to 6, but I think 6 minutes gives me a little bit more time to explain some of the in-depth concepts, and also I think it sounds better with the assonance. So let's get into it. Today's episode is going to be about how to manage short strangles. We're going to go over very quickly what short strangles are, how they work, and how to get the most out of the strategy. Short strangles can be very intimidating for new and veteran traders alike for the simple reason that they are a purely time-based play. You have to allow the strategy to work for you and not lose the forest for the trees in the potential P&L that is being shown on your position. To show you what I mean, I'll just go into the analysis chain for this coin trade here. At expiration, we want the stock to be between our two short strikes. We sold a 125 put and a 200 call, and we want the stock price at expiration to be at or between those short strikes with diminishing returns as we go outside of the strikes to infinity. What that means is, at times during the life of the trade, you can be shown a potential realized or theoretical loss because the stock has moved so far in one direction or the other. So what I mean here is that I have a P&L of about 140, but that's just because we're so close to the 125 put here, and I'll put the theoretical profit on so that you can see we would get more profit if Coinbase actually rallied. So the first tip I have for you with short strangles is to stay calm. Allow the strategy to work. If it's between your two short strikes, most of the time you're not going to need to manage at all. One of the ways that I like to stay objective and not get caught up in the emotion of the trade is to ask myself, am I in the money on this trade? Is my underlying stock at or past either of my short strikes? If the answer to that is no, the vast majority of the time, I'm going to let the trade continue, because that's the goal of the trade. The goal of the trade is to have the stock between your short strikes, and if that's the case, the trade is working, because if this were at expiration, I would have a fully realized profit. And one of the things that you have to do when you're trading stocks, or anything for that matter, is to ask yourself if you're in jeopardy today. The words "what if" are two of the most dangerous words in the English language because they make us emotional. If I'm not in danger today, I can wait till tomorrow. If I'm not in danger tomorrow, I can wait till the next day, and so on. So I'm spending a lot of our 5-minute segment here on this because I believe it's one of the most important things to understand. The short strangle is a time-based play, and you can see here by the nice amount of theta we're collecting, 25 on coin and 20 on ENPH, the strategy will work for you in time. For our more advanced traders out there, or people who are comfortable with the idea of rolling a position constantly, yeah, you may want to look at some of these untested sides and get more delta on the untested side to neutralize the position. I would totally think it's fine to take this 8 delta short call and try to get maybe like 16 or 20 short deltas so that you knock down the overall delta on the position. But that's only if you're comfortable with it. If you're just starting out, I'd recommend leaving the trade alone unless you're tested on one of your short strikes. If you find yourself tested on one of the short strikes, you can always roll the untested side for a credit. And I'll show you what I mean here. If Coinbase were theoretically at 120 or less than 125, I can always buy this untested 200 option and then sell a new option closer to the money. You'll see I'll actually collect about $6 in credit. I'll reduce my deltas on the trade. Remember, I would be long if coin continued to move downward because I've obligated myself to buy stocks, so I would reduce my directional risk on the trade, collect credits, and add more theta and extrinsic value, allowing myself more opportunities for coin to come back in the other direction. One final note on adjustments and rolling the untested side. Understand that when you roll the untested side, you are shrinking the potential room you have for the trade to operate effectively. I have the 125 strike here and the 150 strike here, so now we would want coin to be between 150 and 125 if we rolled this untested side down. I'll clear this real quick so you can see the original trade where we have much more room. So understand that adjustments are to be made usually at the first testing of a short strike. One final thing for seasoned or intermediate traders, or anybody willing to listen to a 27-year-old kid who's been burned a few times, when considering new positions on your portfolio, treat these strangles at their current deltas and not what they could turn into. So what I mean is, my coin and ENPH strangles right now are at about 32 beta-weighted long deltas. So I'm going to treat these like long trades when considering the composition of my portfolio. If the market continues to go down, these trades are going to get longer, so I'm going to look to place more short delta trades to balance them out, and not placing trades based on the fact that they're neutral strategies. In other words, I'm not considering these neutral positions anymore. I'm considering them long positions because they are long, and you should do the same when looking to place new trades or balance your portfolio accordingly. Well guys, that's it for this 6-minute bit. I hope it was useful. I hope you learned something. If you did, don't forget to like, comment, and subscribe. See you next time.